Hello LinkedIn, this is Robert Eldridge, and today's short video is going to be about 5 captive insurance company myths. First off, a captive insurance company is an insurance company you own. It is not a self-funded plan. Myth number 1, all insurance captives are tax shelters or tax havens. This is simply not true. A tax shelter or tax haven is simply put together to avoid paying taxes. An insurance captive does provide tax-preferred treatment on reserve accounts, as well as a host of many other benefits for the employer and employee. Myth number 2, all captives are offshore. You know, about 5 to 7 years ago, this was true, but the individual states started writing captive laws because they wanted to compete for your captive business. Myth number 3, captives only cover one type of risk. Again, this isn't true either. Your captive insurance company can cover risks like employee benefits, health insurance, workers' comp, liability, loss of reputation, loss of market share, and also cyber insurance. In fact, you can customize your plan to fit your company's needs. Myth number 4, captives are bad for business. When you set up a captive insurance company, it should be set up for the right reasons from the beginning. Some of the benefits include creating a profit center out of your captive, better management of insurance risk, reducing the amount of money you spend on commercial insurance policies, and if your company makes less than $250 million a year, yes, there is a tax benefit. Myth number 5, only Fortune 1000 companies can have captive insurance companies. This isn't true because of 831B election. Captive insurance companies can be formed by companies that make $1 million to $250 million a year. So it's not just for Fortune 500 or 1,000 companies like Microsoft, Coca-Cola, or Hyatt. So if you have any questions, contact my office, book a call, or watch my free 15-minute captive webinar. Thank you so much and have a great day.